This course, we'll be talking about the 5 pillars of technical analysis. We'll dive into technical indicators, what they are, how they work, and how you can use them to be most profitable in your trading. We'll talk about technical oscillators. They tell us which direction a market or stock is moving in and how quickly we can expect the move. We'll talk about chart patterns and how to use them to identify entry and exit points for your trades. Being able to correctly identify a chart pattern will greatly enhance your profits. Then we'll talk about candlesticks. Candlestick charting is at the heart of technical analysis. Properly reading a candlestick chart will allow you to identify turning points in the market or your stock, allow you to enhance profits, and to protect your capital. And finally, we'll talk about trading psychology. We'll identify mistakes to avoid and talk about the importance of setting up a trading plan to make sure you get everything you can out of the market. In the complete technical analysis trading course, we'll provide you with a strong technical analysis foundation. We'll go over definitions early so that you understand what we're talking about and we're all on the same page throughout the course. We'll talk about reading charts effectively. You'll learn how to identify trends in the chart and look for key turning points in a stock's movement. You'll learn how to trade safely with support and resistance, two of the most important aspects of technical analysis. If you can correctly identify support and resistance, you'll greatly enhance your trading profits. We'll talk about how to quickly identify market trends to ensure you have the best chance to profit from every trade you make. We'll also talk about how to trade chart patterns and candlesticks. Patterns and candlesticks are a great way to identify the most likely direction a stock is taking. They also predict key turning points in the market and can help you protect your hard-won profits. For each of the indicators and strategies we talk about, we'll go through what the indicator is, how to set it up, what to look for on a stock chart, and how to employ strategies with the highest percentage win rate. We'll use real-world examples so you know exactly what to look for when researching markets or stocks to trade. And with that, let's get started. If you're looking for a comprehensive course that teaches you how to profit by trading with technical analysis, you come to the right place. Take this course and I'll see you on the inside. Our first module is on technical analysis fundamentals, and in this first video, we'll be talking about understanding technical analysis basics. Technical analysis focuses on price, volume, and chart patterns. In technical analysis, we'll use charts to examine the past history of a stock in order to predict the future movement of a stock price. Usually this is over a relatively short period of time. We'll talk about that further in the course. In contrast, fundamental analysis looks at a company's financial statements in order to assign a valuation to a stock. Fundamental analysis is focused on balance sheets, cash flow statements, and other financial statements. Fundamental analysis is focused on the valuation of a stock and whether an investor should buy at a specific price, and is usually focused on a longer term type of investment as opposed to trading. We're going to go over a few technical analysis terms so that we're all on the same page as we move through the course. The first term we're going to talk about is price action. And price action is the movement of a stock price over some range, usually in a defined period of time. Next, we'll talk about trending or ranging stocks or markets. A trending market or stock is moving up or down. So it's moving in a specific direction. And a ranging stock is a stock that is usually trading between two price points. It's moving up and down without an identifiable direction. A breakout occurs when a stock moves above a price resistance level, but which we'll talk about later in the course, and it usually happens on heavy volume. So a breakout if a stock is trading between $8 and $10, say for several months, and then the stock moves above $10 to trade at $10.25 and then $10.50, that's a breakout. Momentum trading refers to buying a rising stock or shorting a falling stock in a short time frame. So momentum traders are focused on stocks that are moving. They have to have a stock that has volume and is moving in a direction in order for their trade to work. Volatility measures the likelihood that a stock price will move dramatically over a short period of time. So a high volatility stock has a very high likelihood of moving a large amount in a short period of time. An example of this would be a biotech stock that comes out with news that their new drug has been approved by the FDA. Then that stock will become very volatile, usually move up rapidly. Usually low volatility stocks are something like utility companies. Really large mega cap companies are less volatile than, say, small cap companies or micro caps. Well, we'll be talking about each of these terms in depth during the course. Now I'd like to introduce you to the type of chart we'll be using throughout the course, and that's the Candlestick Chart. We'll be using TradingView.com for our charting software throughout the course. And the particular type of chart we'll be using is the Candlestick Chart. You can set the TradingView charts to candlestick by clicking in the upper left. Bar charts is the first option, and then we'll be using the first candle option. What I'd like to do is go over what a candlestick is so that we're on the same page when reading the candlestick charts. In this particular chart, the colors are red and green for the candlesticks. A green candlestick means that the stock opened at a certain price and then finished above that price on the day. And then a red candlestick means that the stock opened at a certain price and finished below that opening price on the day. And I've labeled this candlestick in the middle, the large red one, so that you can see what the 4 pieces of information a candlestick give you are. The candlestick gives you the open, the high, the low, and the close for the day. So this particular candlestick, the high for the day is 107.90. It's indicated by the top of the candlestick here. And you can also read the number at the top of the chart here. The top of the solid portion of the candlestick is where the stock opened for the day. And the bottom of the solid part is where the stock closed for the day. The low is represented by the wick at the bottom of this candlestick. And again, you can look at all 4 of these numbers at the top of the chart when hovering over the candlestick. Well, we talked about price action earlier in the video. This daily candlestick gives us the price action for one day. And we'll be using these candlestick charts in various time frames to illustrate various concepts throughout the course. Now I look forward to seeing you next time. We'll talk about uptrends, downtrends, and sideways or consolidating trends. See you there, everyone. This is Steven, and I'd like to welcome you back to our second technical analysis video on market trends. So let's go ahead and jump right into it. There are 3 kinds of market trends that we're going to talk about today. The first trend is the uptrend or bull market. And this is a move upward in a market over a fairly extended period of time. In a bull market, each peak and trough is higher than the previous one. What that means is each movement up followed by a subsequent movement down is higher than the previous movement up and movement down. Bull markets are generally less volatile than bear markets. It's not always the case, but usually. And the movement in a bull market is usually slower when compared to a bear market. A downtrend or bear market is when a market moves down over an extended period of time. In this case, each peak and trough is lower than the previous one. Bear markets tend to be more volatile than bull markets, and they also tend to happen more quickly than a bull market. And we'll see that in a couple of charts that we'll look at in just a minute. Finally, the third type of market trend is a sideways or consolidating market. In this case, a stock or market is moving in a range between 2 price levels. A consolidation can be a trend unto itself. You can have a consolidating market that consolidates for years, or you can have a consolidation movement within a bear or bull market. So you'll have a strong move up and then a consolidation for some amount of time where the market moves sideways, and then you'll have another move up. Or you could have the opposite in a bear market where the market's moving down, then you have a sideways movement for some amount of time, and then you'll have a continuation of the bear market. Before we look at a few charts, let's talk for just a second about why we care if we're in an uptrend, a downtrend, or a sideways market when we are trading using technical analysis. When using technical analysis, we're looking for the story behind the price movement in the stock up to this point, and we're trying to determine where the stock is headed from there. So we want to look at the various factors surrounding the stock, the price, the volume, how quickly the stock is moving up or down. And one of the factors that we want to consider is whether or not the market and or the stock is in an uptrend or a downtrend. If we want to trade long the stock, then we prefer a stock or a market that's in an uptrend. And if we want to short a stock, we prefer a market or a stock that's in a downtrend. If we're trading a range-bound stock, then we know where to put our buy orders and our sell orders depending on where the stock is within the range. If it's at the lower end of the range, we'll be looking to buy more. And if it's the higher end of the range, we'll be looking to do more sell trading. And that's why knowing where the general market is headed, as well as knowing where your stock is headed, is important in technical analysis. Now let's take a look at a bull market and two bear markets that have taken place in the last 18 years. The first chart we're going to look at is the S&P 500. The S&P 500 has been in a bull market since March of 2009. If you look at the lower left corner, you can see the beginning of the bull market that said here in March 2009. You'll see the market steadily climb until May 2010, and then you see a slight pullback. As we were talking about before, the market peaked in May 2010, pulled back to a slight trough in July 2010, and then headed back up. You'll see another peak in May 2011, and then a pullback to a trough in October of 2011. But as you'll note, the trough in October 2011 was higher than the trough in July of 2010. So the bull market remained intact. The market climbs again and then peaks in April 2012, which you'll notice higher than the peak in May of 2011. And then you'll see a slight trough in June of 2012, but again higher than the trough set in October of 2011. So again, the bull market is still intact. And you'll see the market steadily climbed up through January of 2015, and then hold back in the bottom of the trough is January 2016 before climbing again. And again, this trough is clearly much higher than the trough set back in June of 2012. Market starts moving higher again, and we get to where we are today in August of 2018, and the bull market is still intact. One thing I want you to notice in this bull market is the size of the candlesticks. Each one of these candlesticks represents a month, and you'll note that there has been a fairly orderly progression to the upside in this market. You don't see a lot of volatility. There is some in the 2015 to mid-2017 time period where you'll have these larger candlesticks. But generally, a bull market is pretty tight. The candlesticks, there's not a lot of range. It's just a continual march to the upside. And I want you to notice the contrast between that and the bear market that we're going to look at now. So let's now take a look at two bear markets that occurred in 2000, between the year 2000 and 2009. The first bear market started in September of 2000. You'll see that the market tops here at 153.59, and this bear market ended with the market being down 50% in October of 2002. A couple of things I'd like to point out. First is how quickly the bear market took the S&P down 50%. It was only 2 years between the beginning of the bear market and the end of the bear market that the market was down 50%. Before that, the market had been climbing for several years in a bull market. You'll see this again as the market began a bull move in October of 2002. For 5 years, we had a bull market up until October of 2007. And at that point, the market turned bearish. And you can see the really sharp declines. I was talking about volatility before and how it's not that great in a bull market generally. But you can see on these monthly declines, there's a really sharp decline in the market. And in this case, this bear market ended with a 57% decline from peak to trough. So let's zoom out now so that we can see both the bear and the bull markets that we've talked about. And you can see the contrast between the very sharp decline, especially in this bear market, but you can also see it over here, and the less volatility, especially after 2012 in this bull market. Again, there's a slight uptick in volatility here, but it's nothing like the volatility that we saw in August of '08 and October of '08 timeframes. As we were talking before about the importance of knowing what type of market you're in when you're trading, you wouldn't want to be long very often in a market that's dropping 50% or in a market that's dropping 57% in 2 years. But if you see a chart like this, where the market is steadily moving up, then most of your trades are going to be to the long side. What the market chart does is give you a big picture frame to begin your analysis with, and then you can go into some of the analytical frameworks that we'll be talking about in later videos. So that's market trends. Thank you for watching, and we'll see you next time. We'll talk about using different chart time frames for different trading styles. See you then. Hi everyone, welcome back. This is Steven. Today we're going to be talking about multiple chart time frames in technical analysis, what that is, and how we use multiple time frames. Let's jump right in. Using multiple time frames allows us to first identify a trend at a high level and then find a suitable entry point. Depending on the time we want to trade, is if you want to trade an hourly chart, if you want to trade a minute chart, or you want to trade a daily chart, you should pick a suitable longer time frame to identify the trend. So let me give an example there. If you want to trade an hourly chart, then maybe you start with a daily chart, identify the trend in the daily chart, and let's say you identify an uptrend. So now that you have identified in the daily chart that the trend is generally up, that the stock or the market is in an uptrend, then you would go to the hourly chart and find entry points on the hourly chart if you're trading in that time frame. You can take the time frames a step further and look at a 5 or 15-minute chart to find entry points for your hourly trading. So usually you'll use 3 and at the most 4 time frames in your trading. The time frames need to be sufficiently different so that you're getting a different view each time. If you're using a 15-minute chart and that's what you're trading off of, then you're basically not going to use a 10-minute chart as your next level down. So your time frames need to be far enough apart to give a distinctly different view that can inform your entry and exit points. As we'll talk about later in the course, multiple time frames can be used with a number of technical indicators. So multiple time frame trading applies to a wide range of indicators and chart patterns. Now let's take a look at an example of how to use multiple time frame analysis in your technical trading. For this example, let's look at Dick's Sporting Goods, or DKS. So in TradingView, you want to go into the upper left, and that's where we can put in our time frame. We are going to be trading off of the hourly chart. So what we're going to do is look at the daily chart in order to get an idea of whether the stock is in uptrend, trending sideways, or in a downtrend. And so what we find here is since late 2016, the stock has been in an uptrend. You had a consolidation move for much of 2017. And then here in late May, you have an earnings announcement. The stock moved up higher and broke out of resistance at this point, traded back down in July and August, and now is moving back up again. So basically, we're looking at a bullish pattern in the stock. So now that we know we're looking at the stock in an uptrend, we'll want to trade mainly from the long side. So now we're going to look at the stock on an hourly basis, which is how we're going to be trading the stock for this example. So we look at the stock, we see that it broke out at around $36. It broke above a resistance level, and the stock is now traded up and is somewhat extended. So we want to enter the stock, and we're looking for an entry point. So we look and we see 36.5, that we have some price action at that point, which may provide support. And then we look at 36 and see a little more support at that level. Now let's zoom in to the 5-minute chart and see what we see here. So looking at the 5-minute chart, 38 is the level where we have some resistance and support. But if we look a little bit lower, we see that around the 37.5 to 37.60 level provides support. So if we want to be more aggressive in our hourly trading, we go back to our hourly chart And though it wasn't really clear before when we looked at it on an hourly basis, we see that there's a little bit of support here at 37.5. And with a 5-minute chart confirming that support, if we decide to take a more aggressive approach, we may purchase some amount of our position at 37.5. So the 5-minute chart is informing our hourly trading. That concludes an introduction to using multiple time frames in technical analysis. I'd like to thank you for watching, and I'll invite you back to our next video where we'll look at support and resistance in technical analysis. Everyone, welcome back to Technical Analysis Fundamentals. In this video, we are going to be talking about support and resistance and why those two technical analysis tools are important to your trading. First, the definition. A support level is a price at which there is demand or buyers for a stock. So, for example, if a stock is trading around $50 and drops to $45 and buyers purchase the stock at that price, and the stock moves back up to, say, $47 or $48 and then drops again to $45 and then rises again to, say, $52 and within a week or two drops back to $45, the $45 price point has become support for the stock. As long as the stock holds at that price and then rallies back up each time it touches that price, that's a support level for the stock. A broken support level can be used as a stop to stop a trader out of a position, and it can also be used to initiate a short position. So let's say you own a stock that you purchased at $47 and it trades down to $45 and rises back up to, say, $48, but you're looking to sell a stock at, say, $55. As long as the stock trades down to $45 and rises back up, you can wait to reach that $55 level. But you've got to stop at $45 because you know that's support. So when the stock trades down to $45 the next time and then trades down further to $44.50, that would tell you as a trader that you need to exit that position, take your small loss at that point. On the flip side, if you don't have a position in the stock and you're watching it and it trades down to $45 and back up to $48 and down to $45 again, and you see it go through $45 and drop to $44.50, you may want to initiate a short position in the stock at that point, because often what happens is the support will become resistance. So let's define resistance. Resistance is a price level where there is supply or sellers of a stock. Resistance can provide an opportunity to sell a stock short or to sell a long position that you're holding in the stock. As we just talked about a second ago, a broken resistance level, when a stock is moving up through resistance, can be used to purchase a stock, or if you're short a stock and it breaks through a resistance level, you can use that as a stop to cover your short position. One important factor about support and resistance is that the longer support or resistance has been in place, the more important those levels are. So a break through either a support level to the downside or a break above or through a resistance level to the upside, if that level has been in place a long time, is a great opportunity to either go short a stock that's breaking through support or long a stock that's breaking through resistance. Now let's look at an example of support and resistance and how we draw support and resistance lines. For example, we're going to use Emerson Electric Company, or EMR. As you can see here, we're looking at a daily chart, but support and resistance levels work on all time frames. As I said earlier, the longer the support or resistance level has been in place, the stronger that level will be. First, we're going to look at support. And in this chart, we see the stock move down to approximately $66 and change. In February, the stock moves up to the $74 range and then comes back down again to the $66 range. It goes a little bit lower. And here's an important point to make when looking at support and resistance, and that is that you need to give a little bit of room for your support and resistance levels. The higher dollar value of the stock you're trading, the more leeway you need to give in those levels. If it's a low percentage move through the support or resistance, it should not trigger a stop. It's up to you the exact amount that you want to see a stock move through a support or resistance level to trigger a trade, but in most cases, you will not use the exact level. And that's why you'll often see a range drawn when we're looking at support and resistance. So this support level could begin around 66.25 and go down to 65.14, which is the low on both April 6th and April 2nd. Now let me show you how to draw the support line. In the upper left, you'll click this bar and you'll get a menu, and we're going to draw a trend line. So basically we're going to click our mouse. Again, don't worry about it being exactly on a number, just an area. You want to eyeball this area. So we're going to draw a straight line across and click again, and that'll lock the line in place. So now this is our support line right around 66. And if we look with Emerson, right around $74, here's a resistance level. As you can see, multiple times the stock trades down to the 66 level, back to 74, down to 66, back up, not quite to the 74, back to the 71, back down to 66, back up to the 74 level again, down and up and so forth. As you can see, recently the stock broke above the 74 level, which would trigger a buy if you're trading the stock, or it might trigger a trade to cover a short position. And I'll draw now the resistance level in the same way. I'm going to click. I'll click again. And now we have both our support and resistance level. As you can see, you can make several trades in the stock over the course of the year using these levels. Selling when the stock gets in the $74 range, and then buying back the stock when it gets somewhere in the $66 to $67 range. Thank you for watching this video on support and resistance. And we hope to see you in the next video where we'll talk about levels, trend lines, and channels. See you there. Everyone, I'd like to welcome you back to the Wealthy Education Complete Technical Analysis Trading course. Now today we are going to be talking about levels, trend lines, and channels. Let's jump right into it. In the last video, if you'll remember, we talked about support and resistance levels. Today we'll continue to talk about support and resistance, but we'll talk about how support and resistance levels can change when a stock is in a trend. In our last video, the support and resistance lines we were speaking about were mainly flat. We'll also be talking about trend lines, and trend lines can be drawn when a stock is moving up or down. A trend line can help provide an entry or exit point for a trade. And finally, we'll talk about channels. Channels can be drawn around a trend to indicate peaks and troughs in the trend, help predict where the next peaks and troughs will occur, and also indicate that the trend is ending or changing course. These lines are easiest to understand when looking at actual charts, so let's go ahead and jump right into the examples. We're going to be using a chart of Microsoft for our example today. And as we talked about with support and resistance lines in our last video, trend lines can be drawn over a variety of time frames. For this example, we're going to be using a daily chart, but you can also use trend lines on weekly and monthly charts, and you can also use them on hourly charts, 15-minute charts. It doesn't really matter. As we can see with this chart of Microsoft, this stock is in an uptrend. With the bull market we've had the past 10 years, you'll see a lot of charts that look like this Microsoft chart. So what we're going to do is draw a trend line under the stock price. We need 2 points at least to start our trend line. And we're going to draw it just like this and put it there. So now that we have our trend line, let's talk for just a second about what the goal of the trend line is. As the trend line intersects the stock when it pulls back, what we'd like to do is use the trend line to find a good entry point into the stock. As we said, the stock is in a bull market, so we're going to be going long the stock. What we're looking for is a pullback to the trend line in order to initiate a purchase. And once we've made that purchase, if we're actively trading the stock, we'll need a price target. And that's where a channel comes in. So what we're going to do is draw a second trend line above the rising Microsoft stock price. And now we have a channel. The stock rises to the top of the channel, falls back, rises, falls back and rises again. So if we're able to purchase the stock at the bottom of the channel, depending upon our trading strategy, we may sell the stock at the top of the channel and then purchase it again when it reaches the lower portion of the channel. Each time it touches the bottom part of the channel, these become rising support levels. And each time it touches the top of the channel, these become rising resistance levels in the stock. Therefore, you can see that support and resistance levels aren't always flat, but in a channel, they can be rising or falling. This is an upward channel, and the same would be true in a downward channel. You would have falling both support and resistance levels. Now let's take a look at a different chart where a stock is breaking its trend and leaving the channel. Let's take a look at the stock of Activision Blizzard, or ATVI, and the channel it has formed since May of this year. We're going to draw our trend line from the low in late April up when we see the stock was in a bull market here. And then we'll draw the top of the channel. Here. As you can see, the stock had a fairly tight channel formation, a rising channel formation, until late July, when the stock fell through the bottom of the channel and continued downward. If you have been trading the stock at this point and using this channel, you would have either sold your position or possibly gone short the stock. But in any case, this channel is no longer valid. So when a stock breaks out of a channel, the way Activision Blizzard did here, we can disregard this channel. And possibly here, we may look for a new channel to form to the downside. Thank you for watching this video on levels, trends, and channels. In our next video, we'll talk about trading psychology and some of the mistakes to avoid in trading. I look forward to seeing you there. Hi everyone, and welcome to our video on trading psychology, mistakes to avoid. This is Steven, and we're going to talk today about mistakes to avoid and how you can be a better trader. Trading can be a very difficult activity, mentally and psychologically. Traders are often wrong more than they are right, and most people aren't built to deal with that on a daily basis. Think about your job. If you were wrong more than 50% of the time, would you still find it enjoyable? Think about doctors and lawyers. They often make the worst traders because in their jobs, they are paid to study, put in long hours, and make sure they are right the majority of the time. When an individual with that makeup enters the trading game, it can be very difficult to succeed. Now let's talk about some of the ways you can avoid trading mistakes and how you can make the best of technical analysis in your trading. First, not having a plan when entering a trade is a mistake. You have to know when you'll take profit, when you'll exit the trade at a loss, and if you don't take profit, and how much capital you'll put at risk, just to name a few. Your trading plan should encompass your overall financial situation, the goals you have in trading, and the amount of risk you're willing and able to take in order to reach those goals. One of the biggest mistakes you can make in trading is not keeping a stop. You can have small win after small win and watch your account balance climb steadily and then make the mistake of not keeping a stop and wipe out all of your hard-won gains. Not keeping a stop not only impacts your account, but it also impacts your emotional state. You'll find that when you don't keep a stop, it impacts not only the trade where you made the mistake, but all of your other trades as well. Not keeping a stop will definitely put you in a negative mental state and impact your trading across the board. Proper risk management is essential to growing your account as well. You need to define your risk in every trade and at an overall portfolio level. And you need to make sure that within your trading plan, you control for the amount of risk you can take. As you trade, you'll learn there's a difference between how much risk you can take with your account and how much risk you're willing to take on mentally. On paper, you may be willing to take on a higher amount of risk than you find makes you comfortable when you're actually trading. If you can't sleep at night, you're taking on too much risk. Speaking of that, you should only be trading when you're mentally and emotionally fit. As I said, trading is difficult when you're at the top of your game, and it's almost impossible when you are going through mental or emotional adversity. Finally, your trading plan should include how you'll take profit in the trade. If you do not have the appropriate profit-taking parameters in place, your trading plan will definitely suffer. You have to have an appropriately high level of profit taking in order to make up for small losses that you will certainly encounter as a trader. Trading can be a very rewarding and satisfying endeavor, but only if you have the proper plan in place that is both mathematically sound and aligns with your personality. If your trading plan would make money when executed, but because it conflicts with your personality, you make too many mistakes, the plan won't be profitable. Your plan needs to be both mathematically sound and align with your personality in such a way that you're comfortable executing the plan and you can keep mistakes at a minimum. Mistakes will destroy your profitability in your current trade, and if you make too many, they will destroy a profitable trading plan as well. If you're finding you're making too many mistakes in your trading plan, then you have the wrong plan in place. You can get to the right trading plan through trial and error. But if you're finding you're making mistakes that are preventing you from being profitable, it's time to go back to the drawing board. If you find you're making too many mistakes in your trading, then you need to adjust the trading plan and find one that's suitable for you to eliminate mistakes. Every trader makes mistakes in trading, and you can even make room in your plan for small mistakes. But large mistakes over and over will definitely take you out of the trading game. The good news is that if you're here listening to these videos, you're already working on your trading plan and trying to get better as a trader. Understanding technical analysis can help give you the tools you need to put a trading plan in place that fits your particular style and that avoids crippling mistakes. Thanks for joining me in this video on trading mistakes and how to avoid them. I look forward to seeing you in the next module.